As a high-income earner, your ability to earn tax-free growth on your money is limited. Many tax-free accounts are closed off due to income caps. But did you know there's actually a secret way we can work around these restrictions? It's called a backdoor Roth. I'll explain how it works and we'll walk through the strategy step by step together. And be sure to stay till the end because there's a sneaky rule that could cost you big in taxes if you don't properly plan for it. Hi, I'm Josh Palmer, Director of Financial Planning with the Noble Group. I'm a certified financial planner and have more than 2 decades of experience in the financial industry. For 2025, singles earning $150,000 or less in modified adjusted gross income, or married couples earning $236,000 or less in MAGI, can contribute the full $7,000 to a Roth IRA, or $8,000 if you're over 50. The backdoor Roth strategy comes into play when, due to your modified adjusted gross income, you make too much to contribute to a Roth IRA. Single taxpayers earning more than $165,000 of MAGI, or married couples filing joint earning more than $246,000 in MAGI, are not eligible for Roth IRA contributions in 2025. So for those falling into this category, let's see how we can utilize a backdoor Roth. There's 4 steps to this process. Step 1 is to simply open a traditional IRA account if you don't have one already. Step 2 is to open a Roth IRA account if you don't already have one. Step 3 is to make a non-deductible contribution to that traditional IRA account. Now, what do I mean when I say non-deductible? Well, only certain individuals are able to make deductible contributions to their IRA. That is, they'll be able to use those contributions as a deduction on their taxes, and that is all determined by income limits. These income limits are even lower than the Roth contribution income limits we talked about earlier. So if you're already making too much money to be able to make Roth contributions, this also means by default that you won't be able to deduct any of your traditional IRA contributions on your taxes. So as a result, any contribution you make will be non-deductible. Now there's also a benefit here. Since you're unable to make contributions to your IRA with pre-tax dollars, that is, getting that deduction on your tax return to lower your taxable income, this means you'll be paying all of your non-deductible contributions with after-tax dollars. Since you've already been taxed on this money once, you won't have to pay taxes on it again. Okay, so now that we've made our non-deductible contribution to our traditional IRA account, our final step is to make the Roth conversion. So we're done, right? Nothing else to worry about. Well, not quite. There's 3 instances throughout this process that you could be subject to additional taxes if we don't play our cards right. So let's walk through each of these so that we can be sure we're not subjecting ourselves to any additional tax liabilities. The first instance is when we make our initial non-deductible contribution to our traditional IRA. Now, as we said, since we're making this contribution with after-tax dollars, we've already been taxed on this money. We want to make sure the IRS doesn't accidentally tax it a second time. So when we file our taxes for the year, we need to report our non-deductible contribution with IRS Form 8606. This form tells the IRS that this portion of our IRA money has already been taxed, and therefore we won't get double taxed on it down the road. Okay, so we've ensured we won't be double taxed on our contribution, but the second instance we could be subjected to taxes is while our contribution is sitting in our traditional IRA account. If it makes any gains during that time, we'll owe tax on those gains. So let's say you make a $7,000 non-deductible contribution to your traditional IRA. Let's say over the course of the next few months, that $7,000 grows to, say, $7,200. You would have to pay tax on $200 worth of gains when you convert that to your Roth IRA. So how do we get around this? Well, the solution is to make the conversion to the Roth immediately after making the contribution, so there will be no gains, and therefore we won't owe any taxes on this step. So there's a little bit of planning ahead that we need to do here, but the solution is pretty simple. However, there's one more thing that we have to look out for, and it can potentially have the biggest negative impact on someone's plan to complete a backdoor Roth. But before we dive into that, I want to take a moment to let you know that you can get a personalized video from us covering your own finances. All you have to do is click the link in the description and we'll review your financial situation in a custom video recorded just for you. All right, back to the video. So what is this scary thing we have to look out for? It's called the aggregation rule. This rule states that when you make a Roth conversion, it must be done on a proportional or pro rata basis, meaning your tax liability is based on the total value of all the money you have in all of your IRAs, not just the portion you want to convert. Now, what does this all mean? Well, when we are moving our non-deductible contribution from our traditional IRA over to our Roth IRA, in the eyes of the IRS, that is considered a distribution from our traditional IRA. Now, when we take distributions from our traditional IRA, we are subject to tax on that amount at our ordinary income tax rate. Now, you may say, well, our non-deductible contribution shouldn't be subject to any more tax, so I'll just withdraw that portion of my traditional IRA and nothing else. Well, the aggregation rule says that when we're taking a distribution, we don't get to pick what portion of our traditional IRA we're withdrawing. Both our deductible and non-deductible contributions are aggregated together. So let's say you have $72,000 in your traditional IRA, which is made up of $67,000 of deductible or pre-tax contributions you've made in the past, and $5,000 of non-deductible or after-tax contributions you've made this year. You say, well, I'm just going to convert the $5,000 contribution I made this year to the Roth IRA. Simple as that. But because you have another $67,000 in pre-tax contributions in your traditional IRA, the aggregation rule applies. So we need to look at what portion of your traditional IRA balance is after tax. By taking $5,000 divided by $72,000, we see that 6.94% of your total IRA balance is after tax. Therefore, when we make our conversion, only 6.94% or $347 of that $5,000 will be tax-free. That leaves us with $4,653 that you will have to pay tax on at your ordinary income rate. Now, the good news here is that there's a way around this. We can avoid the aggregation rule by simply having nothing to aggregate with. In other words, if you have no pre-tax money in qualifying accounts, this includes any traditional IRAs, but also SEP IRAs and simple IRAs, we'll be able to avoid this rule. And 401ks, either past or current, don't count towards the aggregation rule. So before you begin to roll your old 401ks to IRAs, you should consider whether a backdoor Roth is something you might want to utilize. Now, we've covered a lot of information in this video, and you may be wondering if a backdoor Roth strategy is actually a good fit for you. Well, if you want to get a personalized look at your finances, which could include things like a backdoor Roth, click the link in the description. We'll review your financial situation in a custom video recorded just for you. Have a great day, and we'll see you in the next video.